Welcome to the weekly deep dive. If you're anything like me, you probably feel like the amount of information coming out at us right now is overwhelming. And honestly, between the AI breakthroughs, the stock market swings, crypto, and the general economy, I just found myself reading endlessly and listening to podcasts but barely retaining any of it. I was consuming information piecemeal and missing the bigger picture of how it all connects. So I decided to fix that with this podcast. It's my solution. Every Saturday, I sit down to synthesize the chaos of the week into one clear narrative. My goal here is really simple. It's to practice articulating complex ideas, to ground myself in what's actually happening, and to help you connect the dots without having to read the entire internet. This is a passion project. It's not about the views and it's not about the hype. So, if it's not about that, then you may ask, what is it about? And really, it's just about understanding. So, having said that, let's get into this week's synthesis. I want you to imagine this, right? Put on your imaginary cap, let's call it, and imagine you walking down into a really fancy restaurant. You walk up to the coat check, you hand over your expensive jacket, and the attendant hands you a claim ticket. Standard stuff, totally normal, right? But then you just stand there for a moment and you watch as the attendant prints out 8 more identical claim tickets for your exact same jacket. And then he hands these 8 tickets to 8 other people walking in the door. Now, imagine that Kochak is actually the London gold market. And the jackets we are talking about are worth roughly $70 billion. It is an incredibly visual and unfortunate thing, but it's really not an exaggeration at all. So, let's start with the structural illusion. Today we're looking at a financial system where the instruments haven't just broken, they have been deliberately and mechanically scrambled. For decades, that exact Kochak scenario was the foundational reality of the global market for the world's oldest reserve asset. It is a systematic built on a profound structural illusion, and that illusion is exactly what we are tearing apart today. We have pulled together a massive, eclectic stack of sources to figure out what is exactly going on under the hood of the global economy. I'm pulling from proprietary financial newsletters along with rigorous macro analysis from various traders. We're also tying it all together with deep dive intelligence from folks like Kenzo Finance and various other bits, just for a bit of interest. We've also got our key technical sources like Reuters or LSEG as they're known these days, Bloomberg and The Economist and alike. This synthesis is necessary because if you are just reading the daily headlines right now, you are getting complete whiplash. The traditional models that govern the last 20 years of investing are just failing in real time. One day the Nasdaq is hitting all-time highs and everyone is euphoric. Then literally the very next trading session, the index drops over 4% in a single day and the fear gauges explode. It makes absolutely no sense if you are just looking at the surface. My mission today is really simple. It's just to synthesize the seemingly disconnected bizarre events into a single coherent framework. And I've been boggled recently because everyone I speak to will know me and will know that I always say I can't understand what on earth is going on because traditional economics that we've been taught just don't seem to be working out. Anyway, we have a blowout US jobs report, an AI funding frenzy reaching absurd valuations, a secret corporate Bitcoin stash hidden inside an aerospace company, and the clandestine crisis in the physical gold market. The secret is that none of these events are isolated. When you trace the flow of capital and map out the plumbing of the global financial system, you see that money is moving in ways we just haven't witnessed in our lifetime. We are watching a fundamental rewiring of global capital. So that brings us on to reading the tape mechanically. And before we jump into the deep end, I just want to set some quick ground rules of how I'm tackling this today, right? To truly understand this rewiring, some of my sources dive into some highly sensitive geopolitical events in the Middle East and specific polling data regarding US presidential approval ratings. And looking at this data, we have to treat it purely mechanical and strip it off emotion, right? So, with that out of the way, we are going to look at these numbers the exact same way I look at an inflation print or a corporate earnings report, black and white. We aren't taking any sides, and we certainly are not endorsing any viewpoints. Ultimately, geopolitics is just another input variable for the global market. A sovereign nation making a military decision affects oil supply, which affects inflation, which affects interest rates, which directly dictates the value of your retirement portfolio. You simply cannot analyze the market without analyzing the geopolitical board objectively. So let's go straight back into the Kojak analogy, right? Because the deep dive into the London gold market is completely mind bending. In the London market, the epicenter of global gold trading, the system completely decoupled from physical reality. Recently, it was estimated there was roughly 500 tons of actual physical gold sitting in the vaults available for delivery. That equates to about $70 billion worth of real metal, which sounds like a massive amount of money until you look at the other side of the ledger and realize sitting on top of that $70 billion of real gold was another $635 billion in paper claim tickets. There is a staggering 9 to 1 ratio, $9 of paper promises for every $1 of actual physical metal. Exactly like our coach analogy, right? And you may ask, how on earth does a bank legally sell something that doesn't actually exist? They do it through what the industry calls unallocated gold. Legally, unallocated gold is an unsecured liability. It is simply an IOU from the bank promising they have enough gold overall to make you whole if you ever ask for it. Investors accepted this because the banks deliberately engineered the fee structure to make physical ownership brutally unappealing by being super expensive. Think about insurance and the like. If you demanded to legally own a specific segregated bar, the bank charged you exorbitant storage, insurance, and management fees. But if you accepted the unallocated IOU, it was virtually free to hold. They essentially bribed the market into leaving the physical metal alone. By doing that, they could continuously print more paper claims, creating a massive deliberate suppression mechanism on the global price of gold. But the music is stopping now, right? Central banks around the world have quietly made a historic shift, moving physical gold above US Treasury bonds as their number one reserve asset. The catalyst that broke the illusion was a regulatory shockwave from the Bank for International Settlements. They implemented an obscure regulation known as the Basel III Net Stable Funding Ratio. This regulation acted as a strict financial stress test. It mandated that banks carrying these massive paper gold liabilities now had to fund them with highly stable, expensive capital. It made the old Kojak shell game prohibitively expensive to maintain, forcing Western banks to start unwinding their massive paper positions. Sovereign wealth funds and Eastern central banks saw this happening in real time and stepped in to aggressively accumulate the actual physical metal. They called the bluff and demanded the physical jackets, causing the oldest money on earth to be rapidly repriced. Hence, we see the explosion in gold. Now let's talk about the digital treasury shift. So while central banks are fleeing paper illusions for physical gold, massive corporations are starting to flee fiat currency for digital scarcity. This brings us to the massive revelation hidden in the stack of SEC paperwork. SpaceX is aiming to raise a historic $75 billion of their upcoming IPO. Obviously, I'm doing this slightly late, so it probably already happened, but essentially what you need to know is buried deep inside the balance sheet tables, they officially disclosed holding over 18,000 Bitcoin directly. Interesting. Who would have thought an aerospace company holding Bitcoin? I wonder why. Anyway, even after recent market dips, there is still a $1.3 billion position sitting in the treasury of a company that builds literal rockets. Under current mark-to-market accounting rules, holding Bitcoin subjects the company to extreme volatility hitting their quarterly earnings report. If the price drops, they are forced to report an impairment charge and unrealized paper loss. So why would Elon Musk and the SpaceX treasury team willingly invite that kind of brutal Wall Street scrutiny? Because it suggests a profound fundamental lack of faith in the traditional instruments of cash management. If you are operating at the scale of SpaceX and holding tens of billions in cash reserves while global inflation runs hot, your purchasing power is literally melting away. SpaceX is making a highly calculated statement. They believe the earnings volatility risk of holding Bitcoin is less dangerous to their survival than the debasement risk of holding purely fiat currency. And because they are such an industrially vital company, their actions completely remove the reputational risk for every other corporate CEO, CFO out there. Another fascinating detail about this IPO is that Musk is reportedly allocating up to 30% of the shares directly to retail investors. When a retail investor wants to buy into a SpaceX IPO, they don't just print new money, they have to sell their existing stocks to generate the cash. This aggressively accelerates a massive macro trend of sources called the Great Capital Vacuum. For the last 23 years, the US stock market enjoyed a structural advantage because the market was actually shrinking. A prolonged era of cheap debt fueled massive corporate share buyback programs. With fewer shares available, prices were mechanically forced higher regardless of underlying economic reality. But that era of the shrinking market is hitting a brick wall right now. The sheer unimaginable amount of physical capital required to build the future of artificial intelligence is smashing that wall. Alphabet just completed an $84 billion share offering to fund massive global AI data centers. Meta has aggressively raised their capital expenditure guidance to between $125 and $145 billion, and both OpenAI and Anthropic are filing for their own massive IPOs. Goldman Sachs estimates that the four largest tech companies will spend a combined $5.3 billion on AI capital expenditure by the year 2030. That money must be diverted from somewhere else in the global financial system. This massive vacuum cleaner is literally sucking the foundational liquidity out of the legacy stock market to fund the physical hardware of the future. It creates a zero-sum game for liquidity, applying a massive aggregate source of downward selling pressure on the broader market. The deep irony is that the technology causing this capital vacuum actively threatens the foundational mechanics of the legacy financial system itself. Our current fiat system relies entirely on endless continuous human population growth to generate the massively larger pool of tax revenue needed to service expanding debt. But AI threatens to automate the cognitive labor force itself. If robots decimate the human white-collar tax base, the sovereign debt market collapses under its own weight. I mean, look at Jeff Bezos' new venture, Prometheus. They just closed a $12 billion funding round to build an artificial general engineer. They are designing an AI system to independently design and facilitate the physical construction of complex machines, explicitly aiming to replace the highest paid human engineering talent on the planet. Yet simultaneously, Bezos is arguing publicly that AI will lead to a massive labor shortage. It is an Orwellian paradox and a tough narrative to sell while major tech firms execute rolling layoffs to free up capital for GPU purchases. Now, we have to look at how this internal tech vulnerability is colliding head-on with external geopolitical reality. Foreign adversaries are looking at objective US political polling data and seeing an administrator facing an angry domestic populace. In international game of theory, a weakened administration is a desperate, constrained negotiating counterparty, so actors like Iran have absolutely no strategic incentive to de-escalate. They benefit from maintaining chaos and stalling. They are intentionally stretching out the conflicts across the region. When shipping lanes remain under constant threat of disruption, global oil prices spike violently, and high oil prices bleed into literally every other sector of the economy, raising the cost of shipping, manufacturing, and food. The domino effect led directly to the consumer price index coming in at 4.2%, driven almost entirely by embedded energy and transport costs. This snaps the trap completely shut on the new Federal Reserve Chair, Kevin Walsh. With inflation surging back to 4.2% in US economy, adding 172,000 jobs, crushing estimates, we absolutely cannot cut interest rates to save the stock market. The futures market are even aggressively pricing in a 40% probability of another rate hike, and high interest rates are the absolute kryptonite for stock market valuations. Some of my sources tend to indicate long-term valuation metrics called market cap to gross value added. I think this is commonly known as the Buffett index. Simply put, it compares the financial hype of the stock market to the actual tangible economic output those companies are generating. Currently, this ratio is at its highest, most stretched reading since 1928. The legacy stock market is mathematically priced for absolute flawless perfection, relying entirely on the assumption that cheap capital will quickly return. But the 10-year treasury yield violently surging to 4.54% destroys that assumption. If the risk-free rate you can get from your government is practically zero, you will pay a massive premium for a risky stock paying a low dividend. But if the risk-free rate surges, you are not going to accept the immense risk of the stock market for a lower return. To make the stock market attractive again, the prices of those stocks physically have to fall. Interestingly, we come across the paradox of algorithmic doom loops. So, when fragile structures are subjected to sudden stress, they don't bend, they snap. We saw the structural vulnerability trigger an intraday air pocket in the options market recently. On the morning, the S&P 500 started to crash, and the market's fear gauge, the VIX, was incredibly subdued around 15. But as the selling started, the VIX didn't tick up normally, it exploded nearly 40% intraday. This was a structural complacency trap. Market makers had sold millions of cheap insurance policies known as put options. When the market dropped unexpectedly, those market makers were suddenly taking massive losses. To protect themselves from bankruptcy, their risk management algorithms forced them to aggressively short the market in a process called delta hedging. It became a self-reinforcement algorithmic doom loop of automated selling. And the terrifying part is that options market makers aren't the only algorithms waiting to trigger a cascade. Massive hedge funds known as commodity trading advisors or CTAs currently utilize automated trend following algorithms. Because the market ground higher for more months, these CTAs are sitting on historically massive, highly leveraged long positions. But they are entirely driven by code and hard sell stops. Data models suggest the market is hovering dangerously close to the aggregate stop loss levels for the entire CTA industry. If the market drops just 1 or 2% lower, it will hit those invisible tripwires. The algorithms will blindly and automatically exit market sell orders to liquidate their positions all exactly at the same time. It will overwhelm the market with indiscriminate selling pressure, triggering further delta hedging and creating a catastrophic downward spiral. So, if you are like me, sitting at home looking at your standard S&P 500 index, you're probably sweating right now. The passive investing strategy that worked flawlessly for 20 years is sitting in the crosshairs. Our sources and my instinct honestly outline a strict, highly defensive asset allocation model called the barbell strategy for navigating the shift. I've mentioned it multiple times over the last couple of weeks and months, and simply put, the barbell strategy means you entirely abandon the bloated, highly correlated middle of the risk spectrum. On one side of the barbell, you hold hyper defensive tangible hard assets, think gold, silver, copper, etc. And on the other side, you go long on major AI contributors, think energy, data centers, transformative technology infrastructure. Honestly, this is not about buying consumer tech apps. It is about owning the underlying picks and shovels of the AI boom. It is the silicon computer power, the massive server farms, the raw electricity generation, and the physical robotics required to make the software function. You own the hard assets for survival and the hyper infrastructure to ride the massive tailwind of the capital vacuum. This leaves everything else abandoned in the middle, a space the sources unequivocally define as the kill zone. Out of the 500 massive companies in the S&P 500 index, 459 of them are currently flat or negative for the year. The entire perceived growth of the market is propped up by just 41 companies tied to AI infrastructure. If you hold a standard index fund, you are heavily exposed to middlemen software companies and bloated consulting firms that are actively being rendered obsolete. To navigate this landscape, you need specific signals on your dashboard to know when the system is breaking down in real time. Our primary watch list signal is Bitcoin. During recent geopolitical stress, Bitcoin definitively failed as a safe haven asset, collapsing 53% from its all-time high. But paradoxically, that failure makes it an incredibly useful leading indicator for pure fiat liquidity, because it trades constantly with no circuit breakers. If Bitcoin fails to hold key psychological support levels, it is a blaring siren signaling a broader systemic liquidity drain. The other major warning signals on our watch list is when the market's reaction function inverts and good news becomes bad news. When the blowout May jobs report caused the major indices to sell off hard, it proved unequivocally that the market structure is profoundly unhealthy. It proved the market is addicted to central bank liquidity injections rather than fundamental economic growth. The legacy companies in the kill zone are suffocating under high interest rates and desperately need a cheap debt rescue that isn't coming. This brings me on quite nicely to the Clarity Act. The very definition of money, value, and capital allocation is actively splitting into two opposing systems. The legacy system runs on fiat currency, paper derivatives, and debt-based expansion. The emerging system runs on physical hard assets, digital scarcity, and the AI infrastructure. The massive, violent transition between these two is what is scrambling your dashboard instruments today. But the architects of the US dollar system aren't just going to sit quietly and surrender their global hegemony. Here, essentially, there is a massive counter strategy quietly being developed called the Clarity Act. If you haven't heard about it, the core idea is to rebuild the global US dollar payment system on digital rails by directly integrating stablecoins backed fully by US Treasury debt. This effectively weaponizes the internet to defend the dollar. Effectively, every smartphone transaction, every digital supply chain payment essentially becomes a microfunder of the US government. It creates an artificial, insatiable global demand for US debt, soaking up the bonds that foreign central banks are currently refusing to buy. So the truly terrifying question isn't just which system will win, it is what happens if both systems succeed simultaneously. What happens if the East successfully builds an impenetrable physical gold-backed economy while the West successfully digitizes and weaponizes its sovereign debt through stablecoins? The global economy literally splits into two entirely incompatible halves. That is the structural shift you have to prepare for. The dials aren't broken, they're just measuring a new reality. We are flying through a Category 5 storm and the instruments are spinning. Thank you for taking this deep dive with me today. Thank you for looking past the daily euphoric headlines and being willing to dig into the actual SEC filings and the cold mechanical macro data. Keep reading the tape, check your stop losses, and I will catch you on the next one.